Hi, this is Randy Finney with Right Side of the Chart, and this is a mid-morning session update for Friday, June 7th, 2019. I want to go over the charts of the indexes real quick. We'll probably just stick to that now, maybe cover some other trade ideas in a separate video, but a lot of movement in the market today, so I want to start there. And what we'll do is a quick overview of the long-term charts, and we'll call this the good, the bad, and the ugly, a lot like that old Clint Eastwood Western movie. So the good is you have so far today, well, this is a weekly chart. Let me start out there. These are levels that are seen in some of the recent videos. I've had this chart. I show you different boards at times in different videos, but we had a level, two support levels here, 173.47 and then 169.68. And you can see on the weekly chart they're defined by a couple candlesticks, some reaction lows right there, reaction highs, and we flirted around that level right there for a while. It's really a resistance zone. You can see we popped to the top of it there, the bottom of the zone, two candles there. So I'm just showing you, this is just, I like to do this. It helps to show how I come up with these support and resistance levels. So there's a gap, a big reaction. And so the good is that we've hammered off that level this week. We're printing a big bullish candle as of now. Week's not over, but to print a bullish engulfing candle, you have to, the body, the fat part of a candle right here, has to engulf the body of the previous candle. So far that's in play, although the day's not over. So if they dumped it hard into the close, we'd still have a green candle. They'd have to really have some big reversal, which is the odds of that are slim to none at this point to print a red candle. So we'll get a green candle, and it may be a bullish engulfing. It looks to be that way right now, but we'll see what happens at 4 o'clock. Now, on bullish engulfing candles, keep in mind you have bullish engulfing candles like this one, and you have bearish engulfing candles. Now, I think a lot of traders tend to use these too frequently. You're not supposed to put a lot of emphasis when you get a bullish engulfing candle in the middle of a trend. What they serve their purpose, or what they are useful for, is identifying major trend reversals when they come after a prolonged uptrend or bull run. And that's a bearish engulfing. So that's what happened back there last fall. That marked the top in the weekly chart here. And you can get a bearish engulfing like you had right here during an uptrend, but what you want to see is other things along with it. At that point in time, we had a sell signal with a break of a minor trend line here, or it's a pretty significant trend line. It was on the daily chart. So that bearish engulfing coincided with a lot of other technical evidence. That's what we were focused on the time. We had divergence there, everything else. This was just a regular run-of-the-mill bearish engulfing in the middle of a trend. So that's just kind of TA 101 stuff. And I wanted to point out that, yes, this is a downtrend, but it's more of a correction. This is just a pullback within this larger uptrend here. This is a correction so far. And so you can't put too much of a weighting, but the thing is, a lot of people will jump all over these bullish engulfings, so it's worth noting. And if it brings in more buyers, and whether it's supposed to mark the end of a prolonged downtrend or not, that can be moot. Like I say, it's not so much what the textbooks say; it's what other traders are doing. And so right now I wanted to point that out. That's the good. And the good is also a reversal, pretty strong reversal off that support level. And then the other thing is, you can see this red line right here. That's the 40-week exponential moving average, which is the same as a 200-day moving average. It does a great job of defining bull and bear trends. We dipped below it intra-week, down into Monday's lows, but we recovered it. So that in itself is bullish. That's a successful defense. And even more bullish than a successful defense and bounce off there is a move under, which is a bear trap. It flushes out weak-handed longs and brings in shorts. So that, again, I'm just giving you the good and the bad. So that's the good so far. And the bad, looking at this weekly chart, is the larger technical posture of the markets. We had a divergent high right here. We have a well-defined trend line off the mid-2015 lows. That was broken last fall, broken, back tested, and we had a kickback rally and an impulsive rejection so far. So we were down 4 weeks in a row. These are 4 red candles. This is week 5. It's a green candle. And again, that was very much to be expected. The size of it, we're still within my upper bounce targets, but we were looking for the bounce heading into the week, Monday, as I said, was a crescendo of bad news where the headlines just couldn't have read more bearish, and that's usually, and the same thing will mark a top as a flurry of like we had back here a couple months ago. Remember how bullish the headlines and everybody was back just a month and a half ago when the market topped. So that's just near-term stuff. And so the bounce again was priced in with the divergences on the 60-minute charts, and those have played out, and that's the bullish case so far. Can we go more? Absolutely, it's possible, but I'll give you my view, and that this is the ugly. I'm hesitant to use this analogy because I know it hits home, and there's probably very few, if anybody, listening to my voice that hasn't lost somebody to cancer or is fighting that horrible disease now. But the way I view charts and technical analysis and this pattern, I would equate this to, let's say, a diagnosis of stage 4 cancer. And I know there's all different types of cancers. Some stage 4s are the survival rate is very, very low to nil. Others it's much better. Depends again on the type of cancer, but let's just generally speaking, I think you get the drift. So what's happened here with, and not just this, what we're looking at, everything else I've covered, breadth deterioration, divergences between 200-day stocks above and below their 200-day moving average, just many things that have been covered in the past few weeks or months is sort of built into the charts. And so that's my view, because I can sit here all day long, just about any given day, and make a bullish case to go long or a security of the markets, and I can make a bearish case. And to do so, it doesn't do anybody any good. You get paralysis by analysis. So when I believe that the case is bearish, I'm going to lay out that case and tell you my views, and also say they may be wrong, but that's what I view right now. So I'm viewing this. The point of all that is I'm viewing this as a counter trend bounce, and as strong as the markets look today, as strong as this intra-week reversal is, I'm viewing it as a shorting op, a bounce back into resistance, a chance to close out longs. We just hit our first target on that Intel long trade. We hit the target on the Apple trade, which again I had the the stop was just clipped, a very, very small loss on that, about a 2% loss, but many of you guys stuck with it, I know. And unfortunately I closed mine out yesterday, my Apple, but I still have the Intel trade, and that one here, let's look at those real quick. Oh, no, let's stay on the charts. We'll get to those in a minute if we have time. So that's the takeaway from this. And if you are bullish and believe the market's going to new highs, which, like I said, it very well could be. This is only about a 10, 11, maybe 12% drop in QQQ, less than that in SPY. And as I've been saying all along, it's certainly possible this is just a correction. And at this point in time, despite my views and the case I make that it's part of a longer term drop in the markets, there's nothing that we can say right now definitively that nobody can say this is anything more than just a correction. So I want to get that out there. I don't believe it is. I'm not going to mix words here. I'm not trying to give conflicting analysis, but as of now, we've held support. We've held above the 200-day, and that's what you're looking at. So I'm still viewing this as we're heading lower, but I'm giving you this because I know a lot of people have different views than I do. And if that's the case, made the case for a reversal here has been being made for over a week now with those divergences building, and there were a lot of opportunities to go long so far. And if that's what you did, then great. You just trail your stops up at this point, pick a reasonable stop, and let it run if you believe the market's going to do this. Because I can tell you this will, in hindsight, and I said it at the time too, may prove to be a golden buying opportunity. And that's where anybody that believes the market has new highs and the economy is has a lot more leg or life left in it, that was probably the best buying op you're going to see since this one right here. So I'm still viewing this the other way around, using this bounce to continue to scale into shorts that I just reversed yesterday. Last night really I was net long into just before the closed out a lot of longs and started to layer back into some shorts, which I'll continue to do, and I'll get to the 60-minute charts and show you those levels in a second. So that's again the good and the bad of it. We'll see which one plays out. Let's zoom down to the daily chart, take a look what's going on there. This is just a Fibonacci retracements For those of you not familiar, I recommend do a quick Google search on Fibonacci retracements. And what you do is you measure. I've measured here from the highs right there where the market topped, or at least QQQ, to the lows. And you can see over here on the left-hand side, you have some numbers, and those are percent retracements. And these are the there's different levels. There's a 78.6 that goes right there. Some other levels you can throw up. I like to look at the 32, 50, and 61.8. And we're right now, we overshot it. We're just a little bit above that 50% retracement on QQQ. So the point being that 32 to 61.8, this is typically where a counter trend rally, if that's what this is, a counter trend rally will stall out at and reverse. So anywhere up to that 61.8. And again, that is not to say it can't go higher. Some rallies will do a full, counter trend bounces will do a full retest and come back in. Again, it's just an average, a level where a lot of the reversals will happen. There are some traders that will trade exclusively off fibs. I just like to incorporate it into my trading, and if it aligns with other things, price resistance, trend lines, and things like that, and then all the better. It just gives you an additional level. So right now we're really between, we're smack between, again, the little bit above that 50, but shy of the 61.8 retracement. Okay, and here, let's just show you something else. Let's go to the last high right here. Move these fib lines over, tighten up to the first drop, which was, comparable to the drop we just had. In fact, very, very comparable. We had a drop from here to here. Here's how you can quickly gauge a move. Draw a trend line and then just move it over, put it there. It's going to show you. So that was almost the same drop, almost the same kickback rally. And look at this. This one stopped just a hair above the 50% fib retracement. So there it is. And really, so as powerful as this rally is, that one was just as powerful. That was from the lows. Well, after that, 1, 2, 3, 4 days. There's a low, 1, 2, 3, 4 days exactly. So for those of you new to trading or investing, this is just what if I'm right, and this is just a counter trend rally, this is exactly what they look like, and it's no different in both the scope and duration than that last one. Nor was that first leg down, and again the retracement is right about where that one was. And then you can play around with fibs, put it on the next level there, and you can see this one had a much stronger retracement. That retrace from that move down, but again you can also go from the highs. And another tool is you can use fib clusters. That's what fib traders will do. So you come in here, well, let's do it here. Let's put it back here. We come here, let's get rid of this other trend line there, delete that. Let's change this another color so it stands out. We'll use that white, and then put this white one right here. That's not going to stand out real good against the yellow, so we'll use a blue. It stands out against a black background. So these are fib clusters right here. Well, we only have this one move so far. Oh no, here's what I wanted to do. There we go, right there. And then you'd have to put up another fib right here because that's a higher bounce. We came from a lower level. There's that 78.6 I told you about. Click OK, and boom. See, there's a fib cluster. What I did, just to clarify, from this reaction high, remember we had this first kickback rally right here, and that ended around May 16th. So there's a major reaction high. You put that also to the low, and it gives you a nice fib cluster between the 50% fib from the original move down, and then that, or maybe that's the 61.8. Yeah, 61.8 just above, and the 78.6. And again, you can do multiple fibs. You can do 3 or 4. And the more lines, that's what you want to look for, these clusters where 2 fibs line up in close proximity together. So I guess the point I'm trying to make there is as impressive as it is at this point in time, you can't really say it's anything more than a counter trend rally. Can't say it's anything less either. Time will tell, and that's where trading gets tough. You have to make you have to have a decision. Now you can stand back if you don't know what to do. That's probably the best thing for most traders that don't have a strong idea of where the market's going. But sometimes eventually you have to make a decision, and I would rather short into strength because of my longer term view. And so again, as I've made clear recently, my plan is to close out longs here from 178 and start reversing and scaling into shorts up to but not above 183 right there. So that's my expected reversal zone. But very important if we go much above that, and that will also come in right about where that fib cluster was. Probably comes in right around that level here. In fact, let's show it to you. Let's put it here on the 60-minute chart. There's the fib line down to the lows. Perfect. Look at that. And this never fails to amaze me on technical analysis. How often when I'll have a marked resistance level that I'm targeting, and I put up the fibs like I did this just now, and I haven't done this before that, only on the weekly chart. Boom, there it is at 61.8. You can't even see the dotted line because it overlaps my 182.93 level perfectly. You could probably just make it out there. So that's to me what I see right now about the upside left in this bounce, most likely. And the thing about it, like I said, I will scale in, average down on a position, continue to add to it, up to but not below that level there. And likewise, if we reverse shy and we start going down, I'll add objectively, like I talked about last night, as certain support levels go. And if you're long or short, let's say you're looking to add to longs or to shorts, the levels it should hold now, all these resistance levels that I had before, they work in reverse now, because resistance once broken becomes support. That's a pretty big level there. We popped right on through it today, but it should contain any pullback. Quotes around should. So if you're long there, you want to step in and buy. But if you're looking to short, a break of that level should open the door up for a move down to the next one, about the 178 level. And so that's how it works. So there's your objective shorting up on a break there, or your objective long entry. And you can keep tight stops on the longs with a stop below. Same thing when you short. You can put your stops wherever you want. This is a volatile market, so with shorts scaling back in, and that's why I wanted to scale in and instead of taking a hard stop. If I had a very high degree of confidence that 178 or 179.73 would reverse, I pointed both out as levels that we could reverse. But if my confidence was high enough, I would have added QQQ as an official short trade there. I very well may now at this point. We're getting close to that level, and I'm not going to hold out for every last penny. So don't be surprised if I throw this trade out as an official trade today. But it is completely up to you whether you take it or not, as always. And I can tell you what I'll probably do. May use a 60-minute chart and add some near-term targets. But if we are where I think we are, I'll probably base the next trade off the daily chart, because this is that big counter trend rip I was looking for, and I think that could open the door up for another major leg down. And like I said, I'll as an active trader, this is the trend that I'm trying to trade or planning to trade, and I will reverse when the chances of a bear market rally or a counter trend rally are high, because I made it very clear nothing is more impressive. As much as I love to short stocks because they fall very fast, they even come up just as fast or faster during bear market rallies, because you have two components. During a bull trend, you have people buying stocks, pulling back to dips. In sharp corrections, you have both the longs that step in when they think it's safe to get back in the water. You have longs buying, natural buyers, and you have the shorts, and what I called the JCL or Johnny Come Lately shorts. Those that wanted to short Monday when the headlines came out on Google and Facebook, the government coming after them. This is just, again, this is trading 101. There's an urge to want to short there, to want to sell your longs. It's a strong urge, just like the urge right here is to go long and buy longs, because it seems like the market will never stop going up. But you have to think contrarian. And the thing about that is, you can't be contrarian for the sake of being contrarian. You can't say, oh, because the market's going up, every time it goes up, I'm going to short it. Or it's going down, I'm going to go long. No. You have to align it up with technicals and make the objective case to go long or short. And that's what we're going to do here. We're going to drill down now to the 60-minute charts. Okay, so this is what we've been focused on a lot lately for the tradable levels. I'm going to take that fib off. I already put up that Fibonacci extension there. We'll get to SPY in a second here, or the Fibonacci retracement, I should say. So that's it. There's my max bounce target zones. Pretty significant resistance. Comes in with some fibs right there. Fib cluster overhead. And that's it. So using this strength to to scale in up to, but not beyond that level. This is where I start to be concerned that it was more than just a counter trend rally, because if you recall, that's the failed breakout. That was the previous high right here, where the previous double top highs in QQQ we popped out. That was a breakout to new all-time highs, and that breakout failed, and that made it a bear trap, a bull trap. I'm sorry. All the bulls that chased long there got trapped. We back tested there once, failed. Back tested again twice, failed. Back tested third time's the charm, boom, dropped. So that is a big level, about 186. And if we pop that, we're probably going to go to new highs. So that's the level at which a point I'll be concerned about stopping out. And again, I will not add above 183 because I'm not going to dig myself into a hole. So that's my trading plan. And you know, if you're long, there's, you know, these are levels that you can continue to add to if they're taken out. You know, break above 183 might open the door for 180. You know, move to 186, break above 186, probably open the door for a run at, and probably a pop above those previous highs up there around 191. But at this point in time, I can tell you this: the risk reward is, pardon my French, god awful for adding longs right now. We are super extended, very overbought here on this 60-minute chart. There's the RSI up around 80 or so. Last time we were this overbought was right here, and you know what happened from there. So you know, sometimes you do get overbought like this. Look, if it's a bull market and we're going to new highs, here was an overbought reading that they shrugged off. So I just have to say that overbought is not a sell signal, but it is an indication, hey, things have gotten ahead of themselves. And if this is a bear market rally and you get this overbought, then you're looking at a big drop coming up next week. So that's how I'm positioning right now. Let's look at SPY for you SPY traders, and of course the broad market. Oof, pushing the upper limits. There's my upper bounce target. Remember, 289. Almost hit to the penny. Look at that reversal. What's the high today? 288.85. Close enough. So there again. In fact, I probably should pause the video and layer on some more. Let me do that right now. Okay, sorry about that. I know that seems like a few seconds. Took me about 10 minutes. I fortunately found one account that I hadn't taken anything out of yet. Alright, so I've sold a bunch of TQQQ, SOXL, reverse those to both the shorts, that's SQQQ, SOXS, and then added in some TVIX with that. So again, it's all about risk reward. Maybe those trades get stopped out, but I really like it here. I mean, that's my max bounce target, and at least on that one account I hadn't even had a chance to reverse anything yet. So it's a longer term account. So anyways, that's where I think we're going. There's the max bounce target, and again, overbought on SPY. There's the same levels in reverse, so not much more to add there. Let's just look at futures and we'll wrap this up so I can get the video out to you guys. So I had these wedges this morning that I've drawn. Remember, an upper line on a wedge is not, this is the important line, it's your uptrend line. That's what triggers a sell signal. There's a lot of reactions on the uptrend line. The upper line that I draw on wedges is simply a divergence line, and at this point now it's almost more of a price channel than a wedge, but again, that's all that matters. You're connecting, you're showing this line here is showing prices making higher highs, and so that's what we have right here. And now it's more of a parallel price channel, and there's still the divergence, as I said, I believe this morning, which would have room to extend. We have roughly equal highs here on the RSI up top, and against prices making higher highs. That's still negative divergence, and of course lower highs on the PPO. So that's what the futures look like. There's your levels, and that's ES, the S&P 500 E-mini futures. And then we just have to move our divergence line up here on NQ, see if the divergences are still intact. Really pushing it on the RSI. We have a slightly higher high on the RSI, but we do still have negative divergence here on the PPO. And so now we need that divergence to be confirmed. By confirmed, I mean I want to see a bearish crossover. I want to see the white line, the signal line, cross below the PPO line right here. And that would give us confirmed divergence and should send us lower. And again, these are levels to watch on a pullback. Longs, you want to go long here. Shorts, you want to, short it here. Your next, you want to see 73, 72 break, and then this is going to be pretty big support. If we come on back test that was a big level. I'm a bit surprised, I won't say surprised, but I favored a reversal there. I was leaning towards that, but again, if I had the highest degree of confidence, we would have shorted QQQ there. So I'm just kind of feeling this rally out as it goes, and I think this is just a blow off top for this rally, this kickback rally. I imagine the shorts, any shorts left that were shorting down here, have now been squeezed out today in this ramp up. So there's your divergences still intact, and the levels to trade on the futures. And as always, I'll do an update, and if anything changes. But as of now, that's my views, and I want to get this video out to you guys quickly because I may add on that QQQ, add it back as an official short trade, as well as the semis. Oh, let me cover that real quick. I know I told you I'd stick to the markets here, but you guys know my long-term views on the semis if you've been a member of the site for any period of time now. And if you're not, if you're new to the site, here's my SOXX chart. There are several semiconductor ETFs out there, XSD, SMH, you can trade them all, but I like this one because it tracks the PHLX SOX Semiconductor Index, and if you want to juice up a short, let's say you have an IRA and you want to short, there are some 2-time short ETF semis, maybe even 1-time, but SOXX is what I like to use if I'm expecting a pretty good swoon down. This is a 3-time leveraged short semiconductor ETF, and SOXL is the 3-time long. Now, the reason I'll trade these, even though I'm always charting this one, is they do have decay over time. So I'll use this for charting purposes, even if I trade those. So I wanted to show you why I added that back after I paused the video, why I went back into reverse from an XOXL being long semis to short, and that's because we bounced back to, this is a bounce back former support. It's a target zone that I have for the bounce. It's a nice gap. See the gap right there? Big old gap. And then 190 at the top of the gap. That's still possible we hit that level, but we're at the bottom of the gap now. I'm not going to get greedy and try to hold out. I favor a reversal here, anywhere up to there. So there we're at 183, 188.23 is the bottom of that gap. We already hit it today at the highs. Let's see, high of 188.38. Yep, we got it. And the reason that's there, I'll show you real quick. Reactions. Number one, the gap. That's the most recent thing, probably the most significant right there. The gap. Gaps often act as support and resistance when tested from above or below. Big reaction high there. We shot a little below it, but it was a reaction low there. And then just a lot of reactions around that former support, now resistance zone around these levels. So I think it's an important level on the semis. And my longer term view is that the semis have a lot more downside. Even if they manage, pop that level and run up here, I think they put in a major top. And I can make the case that the semis are headed, based on this weekly chart, that we're headed ultimately, and I know most people probably won't believe it, and maybe it gets there or not, but ultimately down here at about 102. So you can see on this weekly chart as well, I have a nice defined resistance level from support around 189.59, 189.51. It's that same level. Just don't have to zero it in here. It's on a weekly chart, but there's that was resistance back there quite a bit, and we popped it. So a lot like I showed you that bear trap or false breakout on the NASDAQ 100. There's a false breakout in the semis. That was a big time breakout to all-time highs. It ramped up bullishness like you couldn't believe. And what happens in those bulls, and everyone belongs that bought that breakout, they weren't paying attention to this trend line. When it broke, it said get out of Dodge. That was a sell signal. Then when it broke back below 189.51, that was a bear trap, a bull trap, I'm sorry, because all the longs that chased it were now underwater. And now we're pushing back to that level. So we're not all the way up there yet, but very close to it. And again, this chart tells me that we're going down. We'll probably next stop 170-ish, then down to 144.20. And by that I mean reactions along the way, if it plays out the way I expect, of course. Something like this, boom, boom, boom. Maybe a bigger rally there, maybe not, and then boom. And at this point, and like I did here, and came to long. I've been long for last week, this week since Monday, or I may have went into that last Friday. I may have started scaling out. I'm trying to recall. There's so many accounts, so many positions. But either way, I've been long for this week, and now short, looking for that. And look, if I'm wrong on this, and we start going above that level, then I'll stop out. Nothing ventured, nothing gained. But that's what I'm looking at for the semi. So that may also be added as an official trade. May hold off until Monday to see how things, start. Because we're going to finish the week positive. We're going to put in a green candle, even if we fade this rally before the close today. So, no reason to jump the gun, but I do want to lay these levels out in advance for you guys that are interested. All right, we'll wrap it up here. This has been Randy Finney with Right Side of the Chart. Hope you enjoyed it.